Okay. Hi everyone, welcome to this live TV show. I'm here to share with you my views on the market for this week. As you know, we have just started 2017, so there's a bit of dual trading across the world. We are not yet ready to set the tone across the market. What I can say is that we had the Fed minutes, we have the non-farm payroll, and although none of them was extremely positive, they were neither negative enough to put the greenback under pressure. However, I do believe that the market take it as a good excuse to take some profits out of the table from the November, December rally in the greenback, particularly because, well, uncertainty is coming. Trump is going to take the office in a few days, and the Fed has clearly marked that they don't know what will happen under his administration. So they showed a cautious tone, although in general, they are still in the path of tightening their economic policy. Anyway, it's more than an excuse to take profits, and there are no clear signs of long term bottoms in the greenback uh, against any of its rivals, of course. But still, there's yet, I guess the market is yet to waiting for Trump and whatever he may decide or announce during the first 3 months before taking the market more seriously. I'm not sure at this point is those who are eagerly watching for parity in the euro dollar are now so eagerly waiting for that level. I believe that we may see some further upward corrections in the common currency limited because beyond pound, I know there's the weakest currency across the board. So let's start by taking a look at the macroeconomic calendar, okay, and what we have for this week ahead, and then we will take a look at charts, right? There were some minor reports released so far this week. I don't believe that anything was the only thing really relevant. Sorry, was Chinese inflation. It was slightly below expectations, but it was still in positive ground. And what is more important and not reflecting here in the calendar is that core inflation was higher than expected. So overall, the market is taking that as a good sign. Uh, Data coming from China lately has been or above expectation, generally positive. So that tends to boost investors' mood because it's somehow spoken away fears or economic slowdown, right? That's inflation is depressed because the slow economic progress most economies are doing these years, I should say. But anyway, um, that's what we're getting. And when Chinese data, sorry, is showing us signs of slowdown, well, concerns affect all of the economies. And now the Chinese data seems to be slightly improving, well, that benefits the overall sentiment in the market. Of course, as an immediate reaction, the one that's get benefit first is the OC, because the OC it's a commercial neighbor of China and a big metal producer, and China is a big metal consumer. So that's why the reaction is clear at first or more in USD, right? Rather than in the rest. But in general, it's a good sign. Take a look at what happened with stocks that were trading quite soft yesterday in negative territory, and today we're seeing some improvement in that negative sentiment. Anyway, there's not much in the calendar ahead today. We have some minor reports in the US, nothing really shocking, nothing really a market mover. Maybe jobs opening, the number of new jobs created during that month, open during that month, could be a bit of improvement. But to be honest, it seems like that coming from November, as we start a new year, has become irrelevant, and the market is not paying much of attention to it. It happened yesterday with industrial production and the trade balance in in Germany, with industrial production slightly below expectations. and previous, but a good trade balance, a good surplus. The market pretty much ignored that. It's like they are focusing on the new year and what happened past year. It's overdone, not something usual, but it's going on this week. Anyway, and for tomorrow, there is more Chinese data to take care of. I don't believe that this is as relevant as the ones we already had. I do believe the main focus will be in the UK. Manufacturing, industrial production are, sorry, the most relevant ratings for tomorrow. Figures were quite disappointing, right? And it triggered a decline in the pound. But and I'm not expecting much of a positive reaction, even if the numbers are above expectations, because these days the pound is all about Brexit and comments coming from UK Prime Minister Theresa May, who said over the weekend that they were, well, she said something like, uh, they are living in the euro area for good, meaning, or not what she meant, but what the market understood is that they are not uh, going to remain within the single market, right? She will look for a deal. She's still pledged for getting the best deal possible for the UK, but somehow she hinted that the UK will also get away of the single market, and that's why the pound has plummeted as much as it did since the week started. Anyway, as I was saying, data can fight that. If the numbers are positive, it won't be a surprise because we all know that macroeconomic readings have been quite resilient ever since the Brexit vote. But if the data is negative, on the other hand, will probably fuel pound slide. And I'm not I wouldn't be surprised if we see the pound breaking below 120 before the weekend. Okay. Uh, there's not much more to take care about in the calendar. This um, Wednesday, I would said that we will shift our attention into Thursday with industrial production in the euro area and the minutes of the latest ECB minutes. Honestly, it shouldn't bring us much of a surprise with all of what Draghi already announced during their meeting. So the market will be trying to look for tips on whether it's possible the ECB will taper or not during this year. You know, if you ask me, I see it as an impossible case. The ECB can taper. The only thing that's quite positive coming from Europe is that we had really interesting uptick in inflation both in Germany and the euro area, according to the latest readings. But those figures came, if I'm not wrong, after the latest ECB minutes. So those inflation readings won't be taken into account into the minutes. So I don't actually believe the market will be able to react much to old news. You know what I'm trying to say, right? Anyway, and in the US, we have had some Fed members speaking, and we have more coming. Overall, they are uh, holding on to their hawkish stance, pledging for more rate hikes this year without giving much of a clues. It will be a surprise, and you know, actually most markets are surprises. If they come with a dovish or ultra dovish stance, that will be a surprise, and that will affect the market. But if they maintain the hawkish tone that they had over the past few months, and of course after the rate hike, you know, there's little their words can do to affect the market. Okay, on Friday, trade balance in China, despite market one, it's usually a huge market mover and a huge sentiment barometer, right? Because as you know, China is the second world largest economy, and exports and imports in China are closely watched for all the market because of what I was explained earlier, market sentiment, whether we have economic progress all across the globe or not. Okay, this is taken as an indication of that. I could said that a good indication Okay, what market focus the most is in the imports, right? And while that is not deeply in this particular figures that we get in the calendar, you can read the official data, right? If you click inside here, you can get a link and go to the official list and find there, right, how much oil, how much base metals China had imported in that particular month. And that's usually what more educated traders watch to measure the health of the economy and therefore how the rest of the market will follow through. Okay, more interesting, and also on Friday, the US will release retail sales from December and PPI figures. Um, was a bit of a disappointment that inflation ticked back down in December. So factory output prices will be closely watched now, because if it's negative, and of course alongside with retail sales, we will probably see the dollar dipping further and entering into a mid-term bearish trend, and that could last until the end of the month. Okay, so that's what I'm paying attention today, this week. Sorry. I do believe that the main focus will be those return sales and PPI figures coming from the US. The Michigan sentiment also will be closely watched. It's at multi-years highs, if I'm not wrong, and it's expected to continue upticking. Confidence in Trump in promises, right, has been quite high lately, and the market is still believing in it. If not, take a look at the US stocks flirting with record highs, all-time highs. So, uh, if sentiment remains positive among US investors, that will be also be good news for the greenback. Okay. Anyway, let me go to the interesting part. Let's go to charts. Give me a second till I find it. Yeah, it's a bit of delay today in the connection and the sharing stuff within the Hangout. So here we are. We're taking a look at charts. When it comes to the euro dollar, I will change it to the daily chart so you can see what I'm talking about. The euro has a barely correct 23.6% of its latest decline, measured from the US election day high at 12.99 towards 33.40 post at the beginning of the year, right? And despite the dollar is easing, uh, there's no much of buying interest around the common currency for what I can take in charts. In fact, the price has been unable to hold on to gains above the 600 level. Okay, we have a spike to 650, right? The late December. So for me, that's the level to watch these days, because if a pair manages to correct above it, there's scope for another layer higher, with my next target being 710, which is the 38.2% retracement of that mentioned slide. Honestly, I'm not seeing much of a gains above this 710 right now. And what I'm thinking, right, is that if we go back to the weekly charts and draw a line around 800, 840, which is also the 50% retracement of this decline, right? We can see that the pair has bottomed there since early 2015 and pretty much all through 2015 and 2016. So that 840 price zone is for me like a line in the sand. Up to there, market will be correcting, and it will take a clear break above that level to talk about a bullish euro. Okay, if not, the market is correcting and can resume its bearish trend anyway. On the other hand, we have some sort of support coming from that Fibonacci level on this 20 simple moving average around 516, 17. I would say 550 could be the level to break in the short term to talk about further weakness towards the 510 price zone and below that 445 where the pair seems to 440 450 I mean where the pair seems to be quite comfortable or it has been over the last couple of weeks of December. Sorry. Anyway, what I'm also watching is that the price had settled above the 200 simple moving average for the first time in a long time, and also that the short one, the 20 simple moving average, has crossed pretty neat above the 100 and the 201. This is usually taken as a bullish sign, right? But there's no further sign that supports the case for an upward extension right now. The price can reach higher highs, indicators are moving lower, the 20 simple moving average is losing upward potential while the price remains too close to it. So overall, I distrust this kind of signal right now. I'd like to see the price posting higher highs in candles and approaching a bit better to the 650 and before betting to a rally towards 710. Okay. Anyway, the market is the poor euro. It's really hurt. And when it comes to pound, well, we have a sharp decline. 2106 is today low. Okay, 2106, yeah. And the pair has managed to bounce down from the level, but still trading negative territory for the day. And as you can see, the bounces have been quite shallow ever since reaching 124 by the end of last week. Overall, as I was saying earlier, the pound is bearish because the market distrusts uh, the future, the economic future of the United Kingdom once it leaves the euro area, and that will take place according to Theresa May. Maybe, well, it will be a long process that will take 2 years at least, but she will pull the trigger on by the end of March this year, right? So that's what putting investors nervous and they're getting rid of a pound. Okay, I was looking at this daily low from October 25 at 2082. I do believe that's still the level to watch. That's the immediate support, the 2080 region. If somehow the price manages to break below it, it will probably trigger stops. I believe that there's a lot of stops, sorry, accumulated below that level, and therefore the slide would probably accelerate towards the 120 figure. And once again, the 120 level, it's a critical psychological support, but I suspect also large stops below that level, maybe 15 points below it, pips. So if somehow the price pushes through those stops, the decline could extend to 1860 before the month is over. Okay. Anyway, sorry. Okay, there we are. In this 2180, 12190 region is for me the immediate resistance area. So movements up to that level will probably attract some selling interest. Beware of that. We need to regain 22 to talk about an upward movement, a more sustainable upward move up to the 2260, 70 price zone, which I do believe could be tops for the pound for this upcoming days. Really not seeing much of an upward potential there. And when it comes to dollar definition, we have that brutal rally even before your selection, right when the pair topped at 100 and start to recover the election only feel the rally. And now we have entered a consolidated phase because if you take a look at the charts, there's not that we have correct much lower. However, what I also noticed is that after being unable to hold gains above 18, the pair has spent a couple of days and struggling to regain the 17 level and fail, and now it's struggling to hold gains above the 16 level and failing, right? So overall, that's telling me that the risk turns towards downside. We have this low at 1506, and I believe that below that there's not much in the way to for a climb towards the 114 level. It's long-term yearly Fibonacci support. So for me now is the line in the sand. Up to there, the movement is corrective. Below there, I would expect further Japanese yen strength. Okay. As I said, the pair is battling with the regions 116 and 20 could be the immediate support, but I would like to see the pair settling above 1660. Okay, consolidating above that level, or even breaking with a huge acceleration candle, large candle to talk about final recoveries back to the highs. There's sort of a double roof in there around 1816. The neck line was 16, but honestly, the figure has been uh, smashed by these movements we had after the break. The neckline recovered back, now fighting there. Not much of a clear figure going on. In fact, I dismiss it. But anyway, that 1860 region is quite relevant because if somehow the price breaks above it, then there's good chances we can see a 120 during the upcoming days after it breaks, okay? And not before. And when it comes to the Australian dollar, it has been a nice corrective movement. What we had in there, the pair recovered almost sorry, repair recovered the 61 up to the 61.8% retracement of that the latest bearish run. Now it made some selling interest around that 73.80 region. It's pulling back today, but still not seeing much of a downward potential going on right now. It's a major support. What we are pressuring right now, not only Fibonacci level, but the 200 exponential moving average in the 4-hour charts. 20 is heading higher below it. So overall, I do believe that we can talk about bearish move if the pair breaks through 73.30 or so. Okay, that's for me the support to watch for the upcoming hour sessions, because only below that then we can go back to the 73 and lower. I do believe that 72.50 will come back to play if we lost that 73 level, and even lower levels. There's a good chance we'd retest that. But as I said at the beginning, the market is trying to correct the dollar, and I believe that the market, the dollar is buying its own pulse. So not much of that going on in here. Anyway, above this, if the pair breaks above this FIBO, 74.50 is then my next bullish target. I do believe that the pair will find a strong resistance in here, and if somehow it regains that level, well, that will be the end of dollar strength, and the OC could go up to 76. Okay, not talking about this week, of course. Well, who knows? Everything can happen. Something quite similar that what's going on with the euro is going on with gold, as the commodity has found an interim bottom and start to recover. Remember what we discussed multiple times about 1100 being too close to production costs, right? And for the rally to extend below that level. Um, the fact is that the market has used the Fed and the non-farm payrolls reports and excuse to correct higher in year, but I do still see the more potential well limited. Okay, at least as long as the price remains below 1200. Okay, the 1208 has been a major support during all 2016, so probably we will need to sell above that level to talk about the further upward moves in here. Okay, shorter term, what I'm following, it's not Fibonacci support 1173.20. Okay, I don't see much of a downward potential below that level, and if somehow we manage to retake this high, the gold prices can approach that 1200 area. I see a resistance a couple of bucks below that level. Okay, and finally, oil prices. Um, and oil, it's at risk. Oil is at risk. At the beginning of the year, we had some news saying that both Saudi Arabia and Kuwait had reduced their output, their oil output, right? And that they are compiling with agreement that they made late 2016, and gold oil prices, sorry, held not only held above 52, which is sort of a line in the sun, but they also rallied towards the 2016 late highs, right? But yesterday we have some negative news coming from the oil market, and that's that Iraq, which is the second world largest, no, sorry, the second largest producer within the OPEC, right? Uh, had reached record production highs in December, right? And despite the oil minister of Iraq later said that they will compile also with the agreement during January. The market is not willing to trust much in the OPEC because they have a long history of telling something and doing something else, right? Anyway, that's waiting on crude. We have stockpiles to be released during the upcoming days. The AP report today, the report is tomorrow. So beware of that. Beware of that because if the oil stocks uh, rise, that will be a further weight on crude oil prices. As I mentioned multiple times in these videos, and I will turn back to the weekly charts, 52 was major top, right? Major top for most of this last year and a half, right? And it was a major support previously, taking here. So there's a weekly chart. So 52 is like line in the sand. We are now battling around it. So I would say that if yes, data disappoints in between today and tomorrow, the price will probably plunge back to 50, adding the increase in stockpiles to distrust in the OPEC members. And if we lost 50, then the market will rush to profit, right, from your latest gains, accelerating the slide in the commodity and probably getting back to 46. Okay. On the other hand, if we have really good data and more news that the OPEC is doing as they said, right, the commodity can advance modestly, but to be honest, I'm not seeing much of an upward potential going on in here. I believe the market is more willing to sell than to buy. 53.30 is for me in here, right? 53.30, I could like some follow through above this level, above this region to consider a problem buy up to 55, 56 or so. Okay? Okay, well, let me close this window. Okay. Okay, that's it for today. I hope it was useful. I hope you enjoyed it. And hopefully we'll see back next week. Okay? Thank you. See you soon. Bye.